good, gang? Welcome back to another video. It's Baron the Forex here. So, on our previous video, we spoke about basic terminologies or the basic of technical analysis, candle anatomy, reading the canvas candle, the foundation, what technical analysis is, and candlestick patterns. We spoke about resistance and support. We spoke about identifying market structure, what highs are, higher lows, lower highs, and so on. What an uptrend is, what a downtrend is. We spoke about areas of reversal, what a rally market looks like, a drop-based market looks like, and we spoke about breakouts, retest patterns as well. So we also spoke about the essential technical indicators like the moving average, relative strength index, and the volume indicator. We spoke about risk management as well. In the previous video, it was very informative, like it was very educative. That's why the video is like 24 minutes long. So do so and do well to watch the previous video. And this is part 2 of the video. Actually, this is the part 2 of the basics of technical analysis. And to be precise about it, this is just the continuation. I'm just going to take you all on the remaining side of the PDF because the previous video was that long. So heading back into the PDF. So we also spoke about stop loss, why we should use stop loss, risk to reward ratios, position sizing. We spoke about the workflows, 7, like the step-by-step trading flows. Like you have to analyze the market to know where it's going, whether it's going up or down on a higher time frame. The higher time frame is the overview of the price action actually. So if you know where the higher time frame is headed to, you know when to enter, you know where to exit, you know where to put your stop level and your take profit level. So we also spoke about locating key levels, draw your support and resistance lines. I showed you on the previous video how to do that, so do well and watch that video. And we spoke about waiting for a signal, confirmation entries, and setting the exit and take profit level, like stop loss, take profit levels, know when to enter, know when to exit, know the startup of the trend, know when you want to enter the rally based market or the drop based market, whether it be a downtrend market or an uptrend market. So to expand on those specific charts patterns, it is best to view them as visual representation of tug of war. Like they are fighting, let's just say they are fighting, like the fight between buyers and sellers. So these patterns are highly reliable in crypto because they signal when a trend is losing steam and about to reverse. So all this can determine where the trend is going to and so on. So we have reversal patterns as well, like the head and shoulders. Because of the heads and shoulder pattern, or if you understand how the price action works, you always see a head and shoulder pattern before a reversal happens, or we have a double bottom. So this is a double bottom or a double top. So these are the types of reversal you see or reversal patterns you see in the market before the reversal happens. Or if it's a candle type of reversal, you just see a rejection candle, as I showed before in the previous video. You see a reversal candle, you see an engulfing candle, you see various type of chart pattern, like candle anatomy reversal. So that's why I spoke in previous video. I don't want to elongate on that previous video because I spent my time doing that. So I don't plan on making this video longer than 10 to 5 minutes. So let's get back to the PDF. So a reversal trend based on the heads and shoulders patterns. This is what it's going to look like. This is a very, very clear and basic example of it. As you can see, you see this green candle here is an engulfing candle that engulfed the previous red candle. Like I said, the candle anatomy or candlestick patterns. This is a reversal. It's a sign of reversal. So if you see this candlestick, like this candlestick pattern, this is a candlestick pattern, but in that candlestick pattern you see there's a chart pattern. You feel me? Hope I'm not confusing you. So this is a candlestick pattern, so this whole move is a chart pattern. So as you can see here, this is a rejection candle. So as I showed you before in the previous candlestick pattern in the previous video, this is a rejection candle, so it signals reversal in the market. So where is it reversing from? As you can see, this is a fair value gap. this gap between these three consecutive bearish candle is a fair value gap. This gap here, so as you can see, reversed from that fair value gap. So this is an area of interest. Like I said before, this is an area or point of interest, like internal range liquidity to the external. So this is the external range liquidity, which is this low here. So we went from internal to external, and it went from external to internal. So the internal range liquidity here in this leg is this order block here, as I said before in the previous video. So this is an order block in the sell side, the last selling candle before the bullish uptrend, before the creation of that high and so on. So this is the sell candle that created this high, so it's an order block. So to verify the heads and shoulders pattern, you see a basic neckline like this. You can use a line to draw from this side to this side, so you now see it to be outside this straight line from these 2 points. And if you use your support and resistance level, you will notice that this is your support area. So you either wait for a rejection from your support area or a breakout. In our case here, it was a breakout that happened here. So as this breakout happened around this area, you will notice that price will start moving massively towards the downside, start pumping more moves, because it has answered a lot of sell orders around here. It bought to sell. Price has to buy to sell. It has to sell to buy. And this is our support area. So in this support area, either you enter immediately after the breakout of this support area, or you wait for a retest on this support area. So the retest has to turn support into resistance. So if support turns into resistance, you then target the opposite direction where price is coming from. So if price is coming from the upside, you have to target the other side. Like this is the heads and shoulders pattern, so it's coming from the upside. So after the breakouts and retest of the zone, you target the opposite side, which is the sell side, because for the retest, price is going to buy first. So once it buys, you have to target the opposite direction, which is the sell side, because it's a breakout, retest of that zone, and continuation of the trend, which is the downtrend. So the head and shoulders is one of the most famous bearish reversal patterns. Like I said, is mostly used, and it's a significant chart pattern to add in your beginner's journey. So it signals that an uptrend is ending and downtrend is likely beginning. So left shoulder, price rises to a peak and then declines. Head, price rises again to a significant higher peak, the highest point in the neckline, and declines back toward the previous low. As I said before, right shoulder, price rises a third time but fails to reach the height of the head, showing that buyers are losing strength. The neckline, this is the support level connecting the levels of the lows of the shoulders or the highs. It depends on how you put it or you place it. The signal you have to see before the breakout is when the price breaks below the neckline. It confirms the reversal has happened. Traders often use the distance between the head and the neckline to estimate how far the price will drop. So that's how it works. This is the basic understanding of heads and shoulder patterns. So let's head further down into the PDF. So this is a double bottom. Like you see a W, that is a chart pattern. All this I'm showing are those basic chart patterns. So from chart patterns, that's when you can understand how breakout structure works, trend lines, candle anatomy, change in state of delivery, change of character, market structure shift, and so on. These are just basic terminologies, basic understanding about trading or Forex, let me just say price action. So we have a double top chart. Instead of you seeing it in the bottom like this, the topic says double bottom. So you seeing it in the bottom part of chart or the sell side or the support level, you see it in the resistance level. So in the resistance level, so if you draw your resistance line, it has to touch twice. That creates an automatic double top. So if it touches twice in the top side or in the upside in the resistance level, you have to wait for price to either break or reverse from your support, because it's coming from the resistance. So from resistance to support, from support to resistance. So in our case here, it created two tops, that is two double tops, and this is a double top chart pattern, as you can see here. So after I did that, the first one has to touch the resistance, second one has to touch the resistance to be a verified double top chart pattern. So you then wait for a break of structure of the resistance or a reversal of the resistance to continue trend. So if it's a reversal of the resistance, you have to target the if it's a reversal of the support, which is this level here. If it's a reversal of the support, you have to target the resistance. It's going back to the resistance. If it's a breakout, you have to wait for a retest on the support to turn support to resistance, then target the opposite side, which is the direction it's headed to. So if it's a breakout, you have to do a breakout and retest of that support level. If it's a reversal, you have to wait for price to reject this level, break back up massively, return to where it's coming from, then target the resistance level. So this is an uptrend series of higher highs, higher lows, a break of structure, or a breakout of this zone, That's what you just basically see. Then change of character, which is here, this is the last order block that created this high, and price reverse, broke that order block and changed it into a breakout block with deviate. That is an advanced side of price action and so on. So if it turns support to resistance, you target the other side. So this is the breakout range. Then same thing goes for this buy side. So this one is for selling. Like if you want to sell orders, or if you want to look for sells, this is what you have to look for before you look for the sells. So if you want to look for buys, look for it in the opposite direction or in the opposite way. So instead of you looking for resistance, double bounce on the resistance, you look for double bounce on the support level, then a breakout on the resistance, like I said before. So this is a downtrend series of lower highs and lower lows. So at this point in time, it broke out and changed the state of delivery or character. So if it's at the resistance level, you either wait for a breakout, retest and continuation of the trend, or rejection and massive pullback into this range here, and you target the support where it's coming from. So that's how double top chart and double bottom chart works. So this is just a basic understanding of a double top and a double bottom. Is the overview of it, and is actually clearer. So the double bottom is a bullish reversal pattern that occurs at the end of a downtrend. It looks like the letter W. First bottom, price hits a low point, finds support and bounces back. Peak. The bounce hits a temporary resistance level, which is the neckline. Second bottom, price drops again, but is rejected at the same level, like your support or resistance level as the first bottom. This shows that sellers are unable to push price anymore lower. Then the breakout, that is the entry point. The breakout, once the price rises or confirmation for entry rises and breaks through the neckline, the reversal is confirmed. Like price is no longer buying, it's now selling. The signal, this indicates a shift from a bearish sentiment to a bullish one. A double top and M is the exact opposite and signals a bearish reversal. So we have consolidation patterns, or triangles to be exact. As I said, there are only three types of price action: an uptrend, a downtrend, or a consolidating market, or a sideways moving market. So this is a sideways moving market in this range, same as this before it broke out, same as this. Well, this is just a basic sweep, a fake out, which happened down here. Then you target opposite side. This one is a bullish wedge. This is a head and shoulders pattern. This is a falling wedge, or a bullish flag pattern. That's how they call it. Same thing as this. So you can just use your triangles and map out all this and let price touch your trend lines. So if price is touching your trend line, it has confirmed that the trend line is good, is verified, and is accurate. Most of the time trend lines to work, most of the times it doesn't work, depending on the area of liquidity, depending on the higher time frame that you're taking it from, or the time frame you're taking it from. All that counts. Not that the setup is bad or is wrong, it's just that something is missing. Either you took it from the lower time frame, or you spotted it in a time frame that is not actually accurate with the price action of the day. So we have here, this is a very clear understanding of how you're going to see it on chart or live chart. So you see, this is the high, low, high, low, high, low. So you use your trend line and draw from the bottom side where price is coming from to the upside, or you do this as well, or your support. This is your resistance level. Your trend line can act as support because this has touched countless times on this area. So this is an ascending triangle. This is a descending triangle. This is a symmetrical triangle. So this is how price action works: up, down, with this candle representation of buyers and sellers in the market. So you see price going like this: up, down, sideways movements, breakout, retest, expansion, and so on. So this is a rejection candle that happened around here that confirmed the reversal of the ascending triangle, or the move from the upside. Like it's no longer buying, it's now selling. So same thing goes for me. A rejection candle showed here before the buy to the upside. Rejection candle happened around here, showing that from buyers are no longer in the market now, sellers are taking over. Same thing, it's just vice versa. If you understand it in the sell side, you can implement it on the sell side. So this is a basic representation of the chart, real-time data and live analysis. So triangles represent a period of compression where the price range gets smaller and smaller until it explodes in one direction. That is the breakout. That's this basic meaning, or basic definition means breakout. Ascending triangle, a flat top, which is the resistance, with rising lows. This usually breaks to the upside. Descending triangle, a flat bottom, support with failing highs. This usually breaks to the downside. Symmetrical triangle, both highs and lows are moving toward a center point. This indicates uncertainty and can break in either direction. So traders wait for a confirmed breakout with high volume. So that confirms the trend. So as a beginner, if you want to understand what I'm explaining in my classes, the context of these basic terminologies or basic understanding of technical analysis in crypto, you can trade it in Ethereum, any crypto of your choice, but just understand the basic understanding of terminologies, technical analysis before you enter the fundamental. Or if you want to combine fundamental as well, it works. So you have to understand the context in everything. A head and shoulders pattern doesn't mean anything. If it appears in the middle of a sideways market, it must appear after a clear uptrend to be a valid reversal signal. So like I said before, you might see the chart pattern, but it might not work as you expect it to expand, because there are other things you need to add to it, like time frame alignment, other blocks, area of liquidity, area of internal and external range liquidity, and so on. So that's how it works. So wait for the breakout. Beginners often try to guess the pattern before it finishes. That is very bad. Don't guess. Don't do guesswork. We don't guess around here. I'm going to teach you how to wait, but I'm not teach you how to wait. You have to learn the hard way. That's what I used to tell my students. So you have to teach yourself how to wait for the price to actually cross the neckline before you take your entry from your reversal, break and retest of that zone. So you have volume confirmation. A real breakout should be accompanied by a spike in trading volume. If the price breaks the pattern on the low volume, it might be a fake out. So I hope this concludes the basic understanding or basic terminologies or basic understanding on technical analysis in crypto. So to not confuse you, you guys should always do your research, understand charts. Even if you're not understanding, you don't know what you're doing yet, still come on charts, look at the charts, try to place all these concepts, these terminologies on real life charts, on real life data. Apply your technical analysis, try to understand and master that. You see that along the run, 6 months, 3 months tops, you will start having a basic understanding, a firm hold on the basic understanding in trading crypto technically. So this is the end of the video. Do well to subscribe, hit on the notification bell or the icon, and don't forget to give me feedbacks. If you don't understand what I'm telling you, if you don't understand what I'm explaining, hit me up or DM me. I will go back and start from the beginning and teach you carefully. Don't come and be assuming that this, that you're confused, you're not seeing it clearly. That is not an excuse. DM me, I will come back and take you from the start. Baron the Forex here. Peace out. Maybe the night that my tears might let me know all the stars are blue.